Alrighty, so we're looking at the left-hand side, it's the daily chart. And this premium wick here, that's what I have highlighted. And I showed you the contrast of this last week, this highest high, and then this one in here. So you want to look at both of those. I'm only going to show this one, and you go back to the other chart. But you also want to have this one here, the tallest one on the daily chart with the gradient levels, like this one is. Okay. So the market made a rally like we were expecting last week off of the inversion fair value gap that was called for before it even formed. This retracement lower came on the heels of Thursday. The next day, Friday, we have an inside day. And then we have follow through on the downside. So we have a premium wick here. So these darker lines, the blue and the red is that consequent encroachment level. You can see that here. And we opened up with Asia's session and London open minor buy side liquidity. So here's London and Asia. So relative equal highs. The market rallied off of that after using a sell side imbalance, buy side inefficiency that took out sell side here. That's what this was. They accumulated the stops below there during the London open kill zone, then rallied, shifted market structure, came right back down into an inversion fair value gap. So this SIBI changed its characteristic to that of a bullish PD array. And you can see how the bodies are pretty much respecting the consequent encroachment. I mean, it's a little bit of movement below it, but ultimately this buy side imbalance, sell side inefficiency here, and the inversion fair value gap held it at bay. Then it rallied up, attacking that Asia and London open buy side liquidity. It trades up into that inefficiency, breaks lower, SIBI, so it's bearish fair value gap. Then we break again. We have a volume imbalance in here, the separation between the two candles bodies, okay? And it trades right back up to which is that level right here. That's the upper quadrant of this premium wick. Again, the reason why I'm using that one because it's the tallest one of all these. And it hits it perfectly there after completing the return into that volume imbalance here. Then it gave up the ghost, broke lower aggressively, and then worked this discount wick, put the upper quadrant on that level right there. And you'll see where it lays with that. And then breaks lower once more, trading down into, which is the low of the premium wick of this candlestick right here. And it hits it there. And then we go in London close, and there it is. But it's actually, admittedly, it's becoming a little bit more tricky while we're inside of this range. And what range am I referring to? This high and this low. We're like basically in no man's land. So now it becomes a 50-50 higher or lower. All right, moving on. This is Eurodollar or fiber, a daily chart on the left-hand side, and the 5-minute chart of Eurodollar or fiber on the right-hand side. So you can see we had our old buy side imbalance, sell side inefficiency, and that's this shaded area up here. Now these white lines, all this is me grading this candlestick's high to that candlestick's low. All right, so we can see we had sell side liquidity in the Asian session last night, and then we rallied up a little bit, created relative equal highs for London open kill zone. It trades down, attacking the sell side here, and inside of the buy side balance, sell side inefficiency, bullish fair value gap. We trade down the lower quadrant, overshoot it just by a little bit. The body's staying in the upper half, that's bullish. Comes right back up into this sell side imbalance, buy side inefficiency. Breaks lower, small little gap in here. And then we break lower once more. And the bodies just dip below consequent encroachment of the buy side imbalance, sell side inefficiency, fair value gap there. And we rally up. Now look at this, ready? Hits the upper quadrant of this inefficiencies. And the upper quadrant hits it dead bang on. Perfect. And then extrapolation to the upside, we have a buy side imbalance, sell side inefficiency after a shift in market structure here. And it's a breaker. Low, high, lower, low. Bullish breaker, hits it right there, hammers it nice, rallies up. Another inefficiency here, left open, but it takes the buy side here. Right there, comes back down, hits the old liquidity pool. There, rallies up, trades into this old buy side imbalance, sell side inefficiency that's now where we're below, so it's inversion fair value gap. And we drop down, hit an order block here, bullish order block, rallies up, falls just a little bit short of the upper quadrant, and then it breaks lower. Notice the bodies are staying in the lower half of this old daily fair value gap. Then it gives up the ghost, breaks lower, comes right back up into an old inefficiency here. So when this rallied up and broke lower and rallied through it again, this right here, just like when you're looking for breakers, and this was a breaker. So we have a high, low, higher high. When that low is taken out, it becomes a bearish breaker, and you see it traded to here, right there. So that's a bearish breaker. Well, when you see highs forming like this, where they're reaching up, you want to look for the buy side of balance, sell side efficiency there, because they will act as inversion fair value gap. About 80% of the time, you're going to see inversion fair value gaps form like that. So if you're a reversal pattern trader, turtle soup trader, but don't have the nerve to try to sell above old highs, just wait for it to get into an inversion fair value gap over here as the rallies up into it. Look for those last one or two bullish fair value gaps when the market's making these highs. Wait for it to break through it and then come right back up into it, and then you can sell short there. You don't need to have a huge stop up here. You can use a stop loss right there. Breaks lower again, and we come back up into here for immediate rebalance. Breaks lower once more, consolidates around the old pool liquidity, and then goes into rather sloppy price action back into this old buy side of balance, sell side efficiency. So we have liquidity in here. This has been made jagged there. So where is it smooth? Right below here. So just be mindful of that, and over here, this low. Right, pound dollar. We have a daily civvy here. We traded up into that, and we broke lower last week. You saw that. And we traded down into liquidity here and the low here at the lower quadrant of the inefficiency. We had a civvy here between these two candlesticks, the high and the low, and that gap, we traded up into that. It's not annotated on my chart here, but you want to be mindful of that. And these levels here are the discount gradient levels on this wick on the daily chart. So these very, very prominent dark lines, that's what that is. And the smaller, thinner lines, that's these up here. These are representing this candlestick's discount wick. These darker, thicker lines represent this area in here for this discount wick. So this discount wick and this discount wick is where you're seeing these two sets of gradient levels. The upper one is this one. All right, so we had sell side liquidity pool here in the London session. So London open kill zone, we rallied up, broke lower, sell side bounce, buy side efficiency, plus a breaker. So we hit that here. The bearish fair value gap and consequent encroachment, it wicks through, just almost filling us in, leaves a small portion open, breaks lower, takes the sell side there, hits the consequent encroachment of this discount wick right here, hits it there perfectly, dead bang on, rallies, fair value gap there, trades down to that, then rips higher, takes the buy side here, retraces once more into this buy side balance, sell side efficiency. Look at the bodies, candlesticks. The bodies of these candlesticks, they are staying in the upper half of that. Notice that the wicks are allowed to do the damage, but it leaves a small portion open, and it rallies up, rips through the buy side here, and takes us into this discount. We're at this discount wick. That's this, and we just fall short on a New York open kill zone, getting up into that lower quadrant of this discount wick. We break lower, rally back up into a bearish fair value gap, and last up close candle before trading lower. That's the change in the state of delivery, that opening price. That's what that is. Okay, it's just simply a change in the state of delivery where the algo goes right back to that, hammers it one more time. It's not mitigating. It's not mitigating the order block. Rallies up, closes in the fair value gap, hits the close of that. I'm sorry, open of that candle, closing in the inefficiency and trading right back to the change in the state of delivery. So what that means is price was spooling higher. And then once it rotates and trades the other direction, you want to see where that last reference point was at that interval, which is in here, it's 5-minute time frame. That opening price, carry it forward, and you see it hit it right there, bang. And now every high frequency trading algorithm, it starts firing, looking for shorts, okay? And they want to get in there as much as they can inside this inefficiency. And it breaks lower, rips into this inefficiency here, digs through it, sell side below that low, ramps through that, small little fair value gap, trades up, fails to get to consequent encroachment, takes us down into 1.04166. That's the low of that candlestick's discount wick. hits it during London close, and then back into consolidation for the remainder of the day. All right, left-hand side, daily chart. Right-hand side, 1 minute chart. Okay, 1 minute showing on regular trading hours. That way it shows you the regular trading hours difference between where we closed at on Friday and where we opened up on regular trading hours at 9:30 Eastern time today. Over here, last week, as I mentioned, I said that this candlestick right here, it's discount wick. You want to grade that. And also note that the fair value gap that's formed right here. And the market trades down into the upper quadrant inside of that fair value gap, and it leaves a small portion between that low and that candlestick's high. It leaves it open. But then we have this wick again, split that in half. That's consequent encroachment. You can see that that's what happened right here. Okay, so on Friday, we traded down into that, hits it there handsomely, and it rips back up bullish, but it's an inside day. So here's Thursday's high, Thursday's low, Friday's high, Friday's low. So it's inside of the previous day's range. So usually when you see that, if you have a directional bias, as I was hinting at, it's usually indicative of continuation, could potentially be explosive to the upside in this case. And we had that here. We opened relative to where we closed at here on regular trading hours. It's a huge gap, but where we opened up at 6 o'clock on Sunday's trading, it wasn't all that terrible in terms of a separation. It looks a lot more here because it had moved up, from the new start of trading on Sunday all through Asia and then all through London and whatnot to get to the regular trading hours of 9:30 Eastern time this morning. So with all this stuff here, I'm going to zoom in and take us right into this portion and into the right, okay? So that's what we have here. We have that regular trading hours opening range gap. Okay, so you can see that little box here. It's indicating the opening range gap. So where we stopped trading on Friday, regular trading hours, to where we opened today, 9:30 Eastern time, regular trading hours. So it starts to rally right away. We create the first presented fair value gap right here. Then we have another fair value gap there. And we reach up in here, do a lot of business in here. We break down potential shift in market structure below that low. So that means this might become a inversion fair value gap. And it does, but it spends a lot of time in here. Okay, it's a lot of time distortion and wants to lure people in going long, looking for this high to be traded back to, and it just fold it over and break it lower. Bearish reclaimed fair value gap, trades up to it there, breaks lower, and this buy side of balance, sell side efficiency, it's traded down through it. So we open, trade right back up into just sort of consequent encroachment. You want to see it fail to touch that if it's bearish. It rips lower, trades into the first presented fair value gap. What was the first presented fair value gap? It was a buy side imbalance, sell side efficiency, or an up close candle. So if we trade down through it, it's going to become what? A premium array in the form of a bearish inversion fair value gap. So it trades up into that here, hits it beautifully, breaks lower, and then takes the sell side below the lows at regular trading hours print. That means that's the low that was given during the entirety of regular trading hours session so far for the day. And it drew down into that liquidity, hits it, consolidates around it, and then starts using the opening range high, which is the actual opening price here. It breaks lower, creates relative equal lows, relative equal highs. This bangs around a little bit in here, and then rips lower through the upper quadrant, falls short of the consequent encroachment of the opening range. And that's this premium wick. Okay, premium wick gradient levels. Just be mindful that this is a little too smooth in here. This is a little too smooth. If it starts to rotate lower, that's fine. We'll deal with that in tomorrow's trading. But for right now, this seems like there's a lot of people that want to be short because they want to try to short all-time highs, and if they are up here, they're really ramping down and putting stop losses here. So it's not hard for it to go up and hit that. But long and short, try to avoid going short. Okay, just try to do your best not to do that. If you don't have any experience or have been doing this for a very long time, just try to avoid being short in these types of markets because it can hurt you. When you're trading all-time highs and it could just in one day just take off and keep going, keep going, keep going, and every time you try to short it, it'll tear you up. What does it reach for? Okay, we're in electronic trading hours. Notice that lower hand, small little city up here. Okay, above this old high. This old order flow in here, it draws up into the inefficiency right before it, right there. And that's what it gave up the ghost today and went back down into this premium wick.